Theoretical foundations. Let's begin with the fundamental question. What exactly are options? Options are standardized financial instruments that belong to the group of derivatives. A derivative is a product whose value is based on or derived from an underlying asset. This underlying asset can take many forms, such as stocks, indices, commodities, currencies, or bonds. An option is what we call a conditional forward contract. This means it involves either a right or an obligation that only becomes effective under certain predefined conditions. At its core, an option functions much like an insurance agreement between two parties. The buyer of the option pays a premium. In exchange, they receive the right, but not the obligation, to buy or sell a specific quantity of the underlying asset at a predetermined price known as the strike price, either within a set time period or on a specific expiration date. The seller of the option, often referred to as the option writer, receives this premium as income. In return, they take on the obligation to fulfill the contract if the buyer decides to exercise their right. This structure creates a clear relationship between opportunity and responsibility. The buyer secures flexibility and potential advantages, while the seller earns immediate income but accepts the corresponding risk. Understanding this basic principle is essential for anyone who wants to trade options successfully. It lays the groundwork for more advanced strategies and for generating premium income in a controlled and structured way. Definition, structure, and how options work. Every option is based on a few key elements that define how the contract works. These components form the foundation of every options trade and determine the conditions under which it can be exercised. Each option includes an underlying asset, a strike price, an expiration date, an option type, call or put, and the contract size, for example, 100 shares per contract. We'll take a closer look at each of these elements in the next sections to make their role and importance easy to understand. Call and put options. Call option. The buyer has the right to purchase the underlying asset. They profit when the price of the underlying asset rises. Put option. The buyer has the right to sell the underlying asset. They profit when the price of the underlying asset falls. The seller, writer of an option, carries the opposite obligation. They must deliver, call, or accept, put the asset if the buyer exercises the option. Advantages of options. Flexibility. Can be used for speculation, hedging, or generating ongoing income. Writing strategies. Limited risk for buyers. The maximum loss is limited to the premium paid. Leverage effect. Larger market movements can be utilized with a relatively small capital investment. Disadvantages of options. Complexity requires an understanding of pricing factors, e.g., volatility, time value. Time decay. Options lose value as the expiration date approaches. An unlimited risk for sellers if no hedging is in place. Difference between options and warrants. Warrants are similar to options, but are not standardized exchange-traded products. They are issued by banks, which set the terms of the contract. Key differences. Standardization. Exchange-traded options are standardized contracts traded on regulated derivatives exchanges, e.g., Eurex Chicago Board Options Exchange. Warrants are issued by banks, which define the conditions themselves, such as strike price, maturity, and underlying asset. Counterparty. For exchange-traded options, there is no single issuer, so there is no issuer risk. For warrants, the bank acts as the direct counterparty, which creates issuer risk. Market participation. With options, any market participant can act as the seller, also called the writer. Warrants are always issued by a financial institution. Trading venue. Options are traded on regulated derivatives exchanges. Warrants are usually traded over the counter or through banks. Pricing. Option prices are determined by supply and demand in the market. Warrant prices are set by the issuing bank and influenced by market factors. Contract structure. Options are standardized contracts, ensuring transparency and liquidity. Warrants are individual securities identified by their specific WKN. Absolute fundamentals. Recap of section. What are options? Options are financial contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a fixed price within a specific time. There are two basic types of options: call and put. A call gives the right to buy, a put gives the right to sell. Buyers have limited risk. They can only lose the premium paid. Sellers, on the other hand, face potentially unlimited risk if the position is not hedged. Options offer flexibility, leverage, and can be used for hedging or income strategies. Warrants are similar to options, but are issued by banks and are not standardized, like exchange-traded options. Exchange-traded options involve no issuer risk and are standardized, while warrants depend on the issuing bank.
Thanks for watching. If you enjoyed this video, please leave a like, subscribe to the channel, and share your thoughts in the comments. Stay informed, stay rational. See you in the next one.